We have Nilesh Shah joining us now, Managing Director at Kotak Mahindra Asset Management Company. We also have Anand Shah, who's Head of PMS and AI Investments at ICICI Pru AMC as well. Gentlemen, great to have you with us here. Nilesh, of course, has been with us every step of the way as we've made newer and newer highs. Nilesh, so it's a pleasure to have you with us here on the program. First thoughts, it was the previous high was 2 months old. There was a bit of a dip, and then we are back at those levels once again. The GDP numbers yesterday kind of showcasing the strength, at least on the manufacturing and capital expenditure side. Your thoughts, Nilesh?
Thank you, Prashant, for having me over here. Clearly, the GDP number, the exit polls, and the participation of investors, both domestic and global, put all these things together, market has reached where they are today.
Okay. Nilesh, I think we are not getting your audio very well, but I'm going to, just try and take that forward. How should investors approach the market now? Because generally, there is this fear of heights, right? When the markets hit all-time highs, you sort of take a step back, allow yourself to, let this market consolidate a bit. Is that the best approach, or should you continue to trade, expecting this market to move up further?
So, Sonia, normally when your market cap to GDP ratio is above 100%, you do get worried. But this time, market cap to GDP ratio is coming on the basis of Triveni Sangam of growth, governance, and green. Our earnings growth is between 15 to 20% better than many peers, governance standards better than peers, and green transformation of economy. So with the 3G of green growth and governance, my recommendation to investors will be, please follow your asset allocation. Yes, markets are doing extremely well, and they should maintain their asset allocation discipline.
Okay, got that. We'll keep that in mind. Nilesh, I'll stay on some more questions for you. Let me bring in Anand Shah into the conversation as well. Anand, good morning. It's turning out to be a very happy Friday for bulls. And, the market has prevailed despite a lot of the worries that Sonia was also alluding to. I think the question people are wondering is that now that we are back at all-time highs, do we go into a bit of a consolidation? Should we be prepared for that? Or do you think there is enough momentum here for this charge to keep going higher and higher? Anand?
Hi, very good morning. So, while we are looking at the all-time highs on the large caps, the rally or the bull market in the small and mid caps had never stopped in that sense, and you've been seeing what's happening in IPO. I think we need to go one step deeper. I think there has been a very clear heterogeneity in the sense that there is a segments of the markets which are doing very well, segments of the market which are struggling. Especially within the equity markets. And if you see what's driving these markets has been earnings growth rate, as Nilesh also said. We have a very strong earnings growth rate. When I dissect that further, a lot of this earnings growth rate is coming from three areas. One is the banks, the second is manufacturing sector, and the third is manufacturing allied sectors, which support manufacturing, mid-cap goods, industrial products, utilities, and others. And these are the three areas which were also relatively far cheaper than the market. So very clearly, if you see, this part of the market is actually leading the market, whereas there's other aspects of the market where earnings growth has been decent, but that was expected, and then the valuation being too high, that's sort of underperformed. So I think to me, from here on, and for that matter, for last 1 year, it's been a stock pickers market. You need to be clearly, evaluating your businesses that you're invested in. And as Nilesh rightly said, one needs to keep an eye on asset allocation, use SIPs, STPs, and other ways of investing so that the volatility, because volatility is going to be here. Next 6 months, we have going to be both globally and domestically, we have various macro events which the markets.
Nilesh bhai, you were talking about asset allocation for between equity and debt. Should one increase allocation to debt a little bit? What's the advice?
No, Prashant. My recommendation will be to maintain equal allocation to your risk weightage in equity and debt. In debt, go for longer duration paper as interest rate cuts are around the corner. And for equity, prefer large cap and larger mid cap over mid and small cap. But this is the time to maintain equal allocation to debt and equity. And within that, you can make little bit of adjustment for duration and larger cap stocks.
Have you been, Nilesh, surprised with the astounding response to IPOs? I mean, there are telltale signs, right? As you said, the one is market cap to GDP, but you're not very worried about that. The tremendous response to some of these issuances again, but one has to take a look at the totality of it. Any thoughts?
So undoubtedly, there's too much of money coming in IPO market when you see without leverage 2,67,000 crore coming for a few thousand crore IPO. It just shows investors are now looking to participate in the market, and they are thinking that IPO is going to give me instant gratification. Most IPOs are getting listed at a huge premium. So it's just play for instant gratification in IPO market. But real wealth is, as Charlie Munger used to mention, it's not timing the market, it's time in the market. Buy good quality stocks, stay invested for a longer term rather than trying to test your luck in IPO market.
Oh, absolutely. I just want to make a couple of mentions on the market. One is that we haven't given up on any of our gains yet. In fact, all we're doing is building onto it. So now the Nifty is almost at a 100-point gain on the index. And the second is that this market has become so broad-based. Just look at the mid-cap index now. Big outperformance there. And this year, the mid-cap index is up almost 40%. While we talk about the Nifty being up about 11%, the mid-cap index is up 38% this year. So broadening of the market is always a good sign. But Nilesh, I wanted your thoughts. There are some new leaders emerging, if you'd want to call them that, whether it's oil marketing companies, whether it's auto companies, whether it's something like, power stocks. So, for example, BPCL, Hero, Coal India have seen big gains in the last couple of months. Where do you see the next leaders emerge from? Nilesh, is my voice reaching you? Okay, I think he can't hear me, so let me just toss that question to Anand. Anand, the same question to you. Where do you see the next leadership emerge from?
I think the other aspect of the market, which we've been discussing about PSUs in general, but the value outperforming growth. I think higher interest rates also means that the cash flows which are closer to you are more valuable than the cash flows which are far out. And in that context, many of the low PE stocks or the relatively value stocks, which also would have strong fundamentals, good earnings growth rate, would definitely outperform equally fast-growing businesses, but at a very high P valuations because they have more longevity of the growth. So I think that's another aspect of the market which is sort of playing out significantly over the last 2 to 3 years. People are perplexed because prior to 2020, the only way to make money was buying into high P stocks, buying into high ROE stocks, buying into high growth stocks which have longevity. But that's changed. So I think market is very interestingly poised. We have strong fundamentals on the domestic side, which is driving a lot of growth. At the same time, we have worries from the global markets, especially the high interest rates, which is again driving different segments of the market here. The second point, which is why some core sector companies are doing better, why some sort of business are doing better, is also difference between the flows. I think we have very strong domestic flows and relatively weaker FI flows. So the large caps have been trading at a much more sanity, whereas the domestic oriented stocks, typically the HNIs and retail and domestic mutual funds invest more into mid cap and small cap. There we are seeing sharp run up. Okay,
got that. Nilesh, hi, morning. Surabhi here. I just wanted to, ask you about the risks, if any. Okay, I don't think we have Nilesh on the line. Anand, so let me ask you about this sort of factor, risks. And we were discussing it with Lata just a while back when the GDP numbers came in that, of course, on the capex side, everything is firing because that's where the government is spending. But private consumption has not been as robust. And then there is this rural recovery, and 1 month we think it's happening, the next month we get numbers which are still anemic. Now, how big a risk is that consumption in rural? And is there anything else on the horizon that you think we should guard ourselves against?
Indeed, I think there's no denying that rural consumption and overall consumption has been weak. Inflation has been very high, and that's also pushing limits to how much one can spend. But you have to understand, look, for far too long, India was actually consuming a lot and manufacturing very little, and to that extent reflected in a current account deficit that needs to run, especially with. I think there is a change, and once we get the manufacturing jobs going, once we get the economic growth going, infrastructure creates a lot of jobs, housing will create a lot of jobs. That in turn will loop back into consumption. So I think for far too long we were consumption first and everything later. For a change, now we are saying infrastructure, manufacturing will come first, consumption will follow. And to that extent, I think I'm not too worried about slow consumption growth as long as we create enough jobs in the market. And for that, eye on infrastructure, eye on capacity creation, manufacturing capex, private sector capex. I think that's something we are very closely watching.
Okay, it's very interesting, right? At a time when the market is at all-time highs, you have other asset classes that are also at all-time highs. Gold, for example, is sitting at all-time highs. Bond yields have cooled off. Interest rates are perhaps moving lower in the near term. So it's difficult to find anything wrong with the market. And that's when sort of you sit up and take a bit of, you get a bit cautious. That's, I guess, a common human behavior. But for now, the going is quite good. I also want your thoughts, Anand, on the auto sector, because we've had some really good numbers come through. Bajaj Auto, for example, just reported a 30% overall growth with almost a 70% growth in their domestic sales, of course, coming off a low base. But is this a sector where you see a secular run over the next, say, 12 to 18 months?
Indeed, I think consumption will remain evergreen. So while consumption is relatively slower than manufacturing and infra, but there's no denying that India has this big demographic advantage, and you top it up with falling dependency ratio, rising earning members per family. I don't think consumption is going away anywhere. And we have seen that for the last 20, 30 years, the India story has been growth in consumption across consumers, durables, consumer non-durables, autos, telecom, all these areas. The Indian middle class and even at the bottom of the pyramid, people have. So I think auto companies are also starting on a lower base. We are seeing year-on-year growth numbers look extremely good, but that's also partly because low base of last year. Nevertheless, we would see when consuming, given that there was a significant slowdown in rural spending, some bit of uptick can be expected ahead of this entire general elections.
No, absolutely, and consumption will stay strong. We are here in the studio waiting to consume our next cup of coffee. So it's coming, I can see it. Anand, great to have you with us here. Thank you very much for your time, appreciate it, and it's always a pleasure. And thank you for joining us on, what's basically a new high day. 20,235 is where we're at.